It's not rocket science, right? It's all things that happen because somebody's trying to make money somewhere. The main driver for everything, right, in the economy. And once you understand what's a derivative, what's a swap, what's finance, what interest rate, all of these things, and then the concept of, I'm giving you some money. If I give you some money, I want some more money back, and then I'm gonna run out of money if I give too much money, so I need to get money. It's that. So once you understand the jargon and the little bit of what that happens, then everything is intuitive. Like, even don't want to speak for anyone else, but there's most of the deals that I do. When I start, I was like, oh, I don't really know what's happening, or you have to think about it to understand it, right? But you have the tools to do that, which is basically what means to sort of be a structured finance lawyer.
Welcome everyone to another episode of 20 Minute TC. Now, a long time ago, was at while in structured finance, and I still say I feel like I don't know much about structured finance, but we're very lucky today to be joined by Cristiana Evans, who is at Linklaters and a structured finance lawyer, to talk about kind of everything you need to know as someone just hearing about this for the first time. Cristiana, I'd love for you to introduce yourself and welcome to the podcast.
So yeah, I'm Cristiana. I'm at Linklaters in the structured finance group. I was at Paul Hastings before this, same doing structured finance. I focus more on sort of securitization, asset-backed securities, but do sort of everything else in between.
Thanks, Cristiana. And let's just kind of dive into it. So I want you to imagine I have just heard structured finance for the first time. How would you explain to me what the structured finance is?
Structured finance is, well, it's effectively finance, but it refers to more complex financial transaction. Um, the purpose of which is to manage risk, or financing projects using sort of more complex, non-standard financing mechanisms. It effectively, more often than not, it involves sort of pulling together and repackaging or converting those assets into sort of transferable instruments like securities that can be sold to investors. I think that's what it is in a nutshell.
Right. And so I want to kind of dig into what complex means there. So I guess my understanding, imagine I had a company, we just went to the bank, we wanted like a normal loan or a different type of loan. At what point would I need a structured product or have like an interest in securitizing?
I mean, in the sort of the example that you've given, if you're a company and you go to your bank and your bank says, okay, I can give you a loan, and these are the terms under which I'll give you the loan, you sort of need to take that or leave it. And there's sort of, you can go to another bank, presumably going to go to a similar kind of bank, and they're going to offer you pretty similar terms. I mean, they might be a bit more competitive knowing they have another offer, but they're going to be pretty similar. Um, Structured finance effectively allows you to get, firstly, a lot more flexibility, and two, sort of access to a larger pool of investors. Having said that, this type of transactions are for, sophisticated um, entities, i.e., banks, financial institutions use this type of financing. Corporates do, but sort of pretty big, with sort of big financing needs. Government asset managers, things like that, use this kind of financing. So just sort of give an example, because I always find that is really easier to sort of strip it down to super basic. But say you're a mortgage lender, and you have £100 and you give 100 mortgages of £100, making it super basic. Um, your mortgage term is 25 years, right? You Once you've sort of run out of your £100, then what are you going to do? You sort of need more money to make more loans, and which is one of the considerants. So you sort of try to get financing for those assets, because a loan, it is a loan to another party, but effectively on your balance sheet is an asset, i.e., it's a promise to get repaid effectively. So you either sort of finance those loans um, to get your money back, to sort of then more sort of lend some more to make some more mortgages, to have some more assets, and of course the spread in there which you retain, so you can make money, etc. But that's a sort of idea as to why you'd go to sort of get uh, to get structured finance put in place to get this finance. I mean, and then for the investor's perspective, i.e., the people who are going to give you the money under securitization to sort of finance those assets, or back secured on those assets, is entities that would like to have exposure to those assets from a finance perspective, but they're not interested in buying a loan. They don't want the sort of the borrower to call them up and be like, "Oh, hi, can I change my payment date from this to that?" They don't have that kind of infrastructure, so they just want exposure to that. And they probably normally would also want it in a form that is easily transferable, i.e., if they don't need that on the balance sheet anymore, they can sell it on, and it's a lot easier to do that with the security, i.e., what would sort of commonly know as bond or a note. So those are sort of the main considerants of this.
Great. Yeah, the example helps a lot. So just so I'm understanding, with the mortgage example, is it a typically then a company or bank who is owed money that tends to be someone that securitizes that, because rather than waiting for the money to kind of be repaid to them, it's better to package it up and sell it off. Is that like am I understanding that correctly?
Yeah, that's right. I mean, you can securitize pretty much anything, right? You could securitize any kind of assets, be those receivables or other kind of assets. I mainly deal with receivables, but there's you can do that for pretty much any assets on which you can take security and which is a promise of some sort of return on them, right? Is yeah, is any kind of asset that a lender would want to have exposure to.
Mhm. And who are the investors? Are they like institutional investors? What's the like typical type of investor that wants to be exposed to this?
Yes, it would be institutional investors. I mean, your investors on this kind of well, firstly, I mean, as a lot of you may know, the financial crisis in sort of 2008, sort of brought about a lot of regulations, and I think structured products or structured finance was sort of at the heart of those regulations. I mean, among many others, but what that means is that again, this is sort of kind of going on a tangent of a bit, but it means that there's a lot of regulation around it. You can't sell sort of securitized assets to retail investors, i.e., consumers, etc. It has to be sort of sophisticated investors who sort of have the ability to I don't want to say the ability, but the knowledge to sort of assess risk factors and perspectives and sort of understand the risk and that they're exposed to when investing in those assets. So it will always be financial institutions, asset managers, etc.
And then what laws, if I'm like someone interested in the space, is there like a big law that regulates securitized products? I presume maybe it depends on certain factors, but yeah, what were I guess those regulations put in place post financial crisis?
So the big sort of regulation, easy peasy, but it's called the securitization regulation.
Nice.
That's a EU regulation, and of course, when we left the EU, that was transposed into the UK securitization regulation, which sort of mirrored the EU version. And then most recently in November, following a consultation, that was changed to the UK securitization framework, which is now split. It's still sort of pretty much the same, but for a few things that have changed, very similar to the EU SEC reg in terms of the actual provisions, but is now the rules are part of the FCA handbook and the PRA management statutory instruments. But yeah, it was still sort of referred to as the securitization framework now in the UK and securitization regulation there in the EU.
Let's imagine like a company or bank comes to you and you as the lawyer, they want to securitize their assets. What how would you kind of describe the process in like stages you go through from start to finish?
Okay, I'll try to break it down a little bit, as in, briefly, and then you let me know if there's anything else. But I mean, if when they first come to me and of course they won't speak to me first, they normally speak to a partner. But they, I suppose the first thing that you need to understand is kind of the needs and objective of the client. You need to understand what the assets are, what they're trying to do, why are they doing what they're doing, or it might be the other way around. They try to do something, or need to achieve something, but they don't know how to do it. And once you sort of understand that, you maybe take it away and have a think about it. Talk to your tax colleagues, your reg colleagues, etc. Wherever you need to. Once you have sort of a few ideas, and then you probably go into the structuring phase. And again, the structuring mainly comes from the client, especially if it's like, say, for example, a big bank, the structured finance desk, who, the structurers, that's what they do. But you sort of work with them to understand how that transaction needs to be structured in order to achieve the goals of the client. And more often than not, you'll have to change a few things from sort of what would be the sort of the term sheet. Well, the term sheet will probably be in sort of negotiation stage at that point, and you'll tweak certain things and add certain things in to make sure that you achieve the desired result. And you might start putting questions to the client, as like, from a tax perspective, do you want this, do you want that? Who do you want to be at the risk retention? Do you want it to be, UK compliant, EU compliant? Who are the investors? Do we need to think about this, that, and the other? And then that sort of, there's a lot of things that dictate the way you sort of structure a transaction, but that's sort of the what I'd call the structuring phase. And then once obviously your then client sort of goes and talks to, it depends, your client is also the arranger, etc. Then they go and talk to the, at that stage you'll have sort of your originator, who's the person that sort of has the asset and wants to securitize them, and then an arranger and a lead manager, and who's the person that will effectively take responsibility of the transaction, so to speak. That things, we can place this product once issued with investors. Sometimes it can be the same person, sometimes different. And then, they sort of, if they need to meet and talk and discuss and agree, once is agreed and there's a term sheet, then sort of the documentation phase start. And that obviously involves us drafting loads of documents. And then those get sort of, and you appoint sort of third parties like your trustee, your sort of agents, etc. The entities, the corporate service providers who will incorporate your SPVs, and if your SPV is incorporated in a different jurisdiction, your, I don't know, Irish council, and sort of kind of the third parties that need to be appointed, you appoint them. And then you start drafting documents. Those documents then get circulated, everyone then comments on it, because everyone will have different inputs into those documents. For example, I don't know if you talk about, your agents, they'll care about their fees and their indemnities and their responsibilities under the docs, and sort of exactly what they need to do and how they need to do it for that to be specific. Um, Arrangers will sort of think from a sort of investor perspective, what would investors want to see in those documents? And your sort of originator wants to make sure that they get the money under what terms, and sort of make sure that the reps and warranties that you give on the document are as accurate as possible. And then once sort of, there's a few turns of this document, you send out documents, comments come back, you put them through, then some comments of some parties might, conflict, and you resolve those issues. Just turn another turn, there's more comments, more turns, etc. Eventually you get to a point where they're agreed. And then we have what's called a closing, which is effectively, signing the deal, funding, and any post-closing issues like registration of security and so on. That it is in sort of an outline.
Amazing. Sounds very effortless, the process.
Absolutely.
So you've mentioned a few parties there. So like the originator, trustees. I wonder, can you just do like a quick fire? Who are the different parties typically, and like in like a sentence? How would you explain like what their role is?
Um, so you'd have, the originator is called the originator because it originates the asset. So it would be, whoever has originated, say, the mortgage loans in the first place. Then you'll have your sort of your trustee, or security trustee, who effectively holds the security on behalf of the investors. And if there's any default under the document, and then they'll have a mandate to enforce that security and sort of do certain things under documents to make sure that the security is realized, and then sort of the proceeds become available for distribution for the investors. That's a sort of a worst case scenario. You have your different agents, like for example, your paying agent, your cash manager, those people are those who sort of collect the money under that comes in from the underlying assets, and then they make sure that money is then applied in accordance with the documents, and you might have clearing systems, etc. Sort of the liaising between that, sort of the payment to the ultimate investors. I think it's important to sort of understand that, for example, under a sort of your normal securitization, the sort of what I'd say the features of a securitization are, the 5% risk retention that I mentioned, the fact there's a pooling of assets, and then the third is that the exposures created by that securitization are tranched, or the risk is tranched. What that means is that effectively the notes that you're issuing to the investors are tranched to have different classes of notes that have a different risk profile. And of course, when you is known in the sort of sacred structured finance space as, the sort of the waterfalls, i.e., you have the class A, class B, class C nodes, and then you have a waterfall that says when money comes in, and you have a difference between principal and revenue, but I won't go into that. But when money comes in, effectively, you need to first pay fees because your trustee and your agent, etc., want to get paid, and then interest on class A, interest on class B, interest on class C, then some other things, and then principal, and then etc. And this will be like a list of, I don't know, 20 items, but then you might only have money to pay. I mean, sort of well-performing securitization, and if anyone has done the job properly, and the profiling of the risk, etc., if all goes well, there's money to pay everyone plus some deferred consideration at the bottom. But if there's not enough money and you only get to pay your class A and B, then your class C note holders, they'll sort of take the hit, i.e., they'll make a loss. And that class of notes will of course have a higher risk profile, therefore you will sort of get more interest, and so on. So yeah, a cash manager and sort of your sort of they need to sort of understand how the money needs to be applied to comply with those waterfalls. You have your issuer, which is effectively, so your originator will sell those assets into an SPV, because the sort of the issuer needs to be achieve sort of like the insolvency remote, the insolvency remote element of it. It doesn't need to be connected with sort of the originator. Um, and that, yeah, you have your sort of your agents, your issuer, your investors, your arranger, who then sort of liaises with the investors, and your sort of lead manager, who would, well, depending on the deal, but would underwrite the deal. But yeah, hopefully that answers it. There's a lot of other parts, but that's it, and sort of like just grouping them in general terms.
Great. Yeah. It's clear there's lots of different parties in the structured finance deal. Just very quickly on the SPV point, do you mind just explaining, like, why does a SPV need to be created?
So again, there's a requirement for securitization that it needs to be remote for insolvency purposes, i.e., if your origin, it can't be like a subsidiary of the originator, because it needs not to be impacted by anything that happens with the originator. So like if your originator goes insolvent, that shouldn't impact the securitization, right? Because that would be another sort of massive risk element for the investor to take on. I mean, they might as well just lend directly to the originator, right? There's a sort of a requirement that the SPV needs to be a complete separate entity. So that SPV will, be sort of held, have like sort of have a holding company, and that holding company will probably be like a for organized charitable purposes, i.e., when everything gets wound up, the whatever, however many £100 left over will get paid onto charity. But yeah, that's sort of completely remote
Mhm.
and unconnected with the originator.
What's the main legal documents that you negotiate?
So the main one would be the offering circular or prospectus, and that's effectively a pretty large document, 300, 400 pages, that provides transaction overview and risk factors to the investors. It's a document that the investor will look at to understand what transactions about, what are the risks in investing in those documents, what are the different parties, what are the different documents, what are different features like credit enhancement, liquidity support, etc., etc. How is the deal structured? What are the notes? What's the rating on those notes, etc. So that offering circular is basically your booklet for what those financial products are, and then everything else is basically the contracts that then sort of make the transaction happen. The prospectus offering circular effectively describe what the transaction documents do, and sort of just to sort of name a few, you'll have your trust deed, and the trust deed will be effectively the documents that detail the terms of the security that are being issued. You have your subscription agreement, i.e., the agreement with investors under which they subscribe for the note, or maybe the lead manager who underwrites the deal and then subscribes and places them. You'll have deeds of charge, or as otherwise named security document. That's the document that deals with taking security over the asset. And sort of agency agreements with the different sort of agents, and your sort of bank account agreement that deals with the bank accounts and structure of the bank account, and what does the account bank need to do when they receive money, what's their mandate effectively. Those are in outline.
I think students often find it useful to understand how practice areas sit within firms. How is structured finance in terms of the practice areas at Paul Hastings and then now Linklaters?
So at PH, it was maybe well, at PH there was I was in the sort of securitization team, or asset-backed securitization team, ABS team. And we did sort of asset-backed structured finance. And that was under a partner called Paul Severs, who's very well known in the market. And then the firm also had other sort of structured finance teams, like they specialize in specific products like CLOs, collateralized loan obligations, as a completely separate department. Those are also securitizations, but just different asset class, and sort of a bit of a different structure. Then there was also a separate sort of structured product derivatives group under a different partner. So yeah, just but we were all part of sort of your structured finance wider group. Linklaters, the Linklaters, I suppose you just described, there's sort of three major groups. Your sort of corporate finance and litigation and international arbitration. And we sit obviously in the finance group, and within the finance group, there's or the finance practice. There's different groups. Structured finance group is one of them, and here we do a range of sort of products. We do a little bit of energy infrastructure as well, utilities. Though we have a separate energy infrastructure group, this is more sort of focused on the sort of structure finance side for that sector, with a lot of asset-backed securities. And then there's a sort of separate subgroup that does sort of your structured product derivatives, repacks. Yeah, so that is in a nutshell. But bearing in mind, I've only been at Linklaters for about 3 weeks and 2 days, so I should caveat that.
Very great. Last question then for you. Many people listening will be either aspiring lawyers, future trainees, maybe interested in structured finance. If you had to just give them one piece of advice about whether it's your experience in the space or the space itself, what would that advice be?
I think I should start with watch The Big Short,
Yes.
which is the advice that I sort of give loads of sort of aspiring solicitors in that space. I mean, to be fair, my advice is that because that's sort of what inspired me. I mean, I have a slight fascination with fascination maybe is the wrong word. The sort of the financial crisis and kind of what happened then and what happened and, the regulation that came after. I mean, I was so young. I mean, I was relatively young when it happened and didn't really understand what it meant. So I started reading about it, Big Short, loved the movie. And then once I sort of saw the movie and kind of realized I didn't really understand much of what was happening, I sort of started sort of trying to understand that. And that gave me a good sort of basis for understanding structural finance. Then I think just understanding, and again, this comes down to like sort of commercial awareness, right? But like understanding your basic finance terminology or products, right? I mean, there's a lot of jargon in the finance space and it's unhelpful. But I think once you sort of work in the field, you understand that it's needed so you don't have to explain every single thing they say. It's all like comprising a certain concept, right? Sorry, I'm making it more concise, but compressing. But it's all pretty. It's not rocket science, right? It's all things that happen because somebody's trying to make money somewhere. That's the main driver for everything, right, in the economy.
Agreed.
Um, and once you understand, what's a derivative, what's a swap, what's finance, what interest rate, all of these things, and then the concept of I'm giving you some money. If I give you some money, I want some more money back, and then I'm gonna run out of money if I give too much money, so I need to get money for it's that. So once you understand the jargon and the little bit of what that happens, then everything is intuitive. Like even, I don't want to speak for anyone else, but there's most of the deals that I do, when I start, I was like, oh, don't really know what's happening, or you have to think about it to understand it, right? But you have the tools to do that, which is basically what means sort of be a structured finance lawyer. So a good book that I read was called Know the City. Again, this was in 2014. I don't know if it's changed name, but I think it was Christopher Stokes.
Yeah.
That's a good, I think, start. I think I read that about 5 times, and it was really hard to understand the first couple of times. And I probably, understand 30% of it now, or remember it, right? But it's still a lot to sort of start with. So yeah, that's it.
Amazing. Yeah, and hopefully people watching or listening can see how clearly you can explain so many of these terms, but you're also saying you can just learn these things. Like you're not born learning what a CLO is or derivatives are. Um,
No, exactly.
Thank you so much for your time, Christiana. This was really helpful. I think we did an event a couple of years ago or last year that was also really good on structural finance, and it's nice to see you again now at Linklaters. Thank you so much for coming on the podcast.